Hello, everyone. My name is Nathan Corey from Richardson Capital Management, and I'm joined today by Dan Brown, our Director of Investment Management. And we are here today with our economic and investment update for the month of May 2024. Well, Dan, after the negative returns we saw in April, we finished the month of May with fairly positive returns in the financial markets, with those returns being fairly, broad-based across different sectors and parts of the market. Some of the key catalysts behind that have been favorable inflation prints and continued resilience of the economy here in the U.S. Both of those being kind of key factors in expectations for interest rates going in through the end of the year. What have we been seeing on that front, and how have expectations maybe shifted over the past month?
Yeah, so expectations did improve over the last month. So as we sit here at the end of May, we see that investor expectations for the first Fed rate cut in September being about a 56% probability. We feel that feels about right. As you mentioned, we did see some favorable inflation prints that softened in the month. So leading up to that, we had seen inflation readings being kind of sticky, but they did again soften or moderate here in the month of May. So improvement in investor sentiment towards rate cuts beginning possibly in September. Again, we think that's about right. And as we look at what the Fed is thinking, what they're saying, they've been adamant that they want to hit their 2% inflation target.
Right.
That might take a while to do that, but again, they're adamant. So we think they're going to remain vigilant on the inflation front. And the Fed really is in no hurry to cut interest rates. The economy is doing fine, as you mentioned, very resilient. Corporate earnings are decent. The employment backdrop is very solid. So we think the Fed can be patient. But again, expectations did improve over the past month toward rate cuts.
With the strong returns we've seen in the month of May, that now marks 6 of the past 7 months with positive returns in the market. And as we kind of see these advances in the market, the key concern on a lot of investors' minds is, are we getting overvalued? And obviously, the main component of that is going to be the earnings on the corporate side. So, what have you been seeing so far this year on earnings releases for those companies that have released? And then what are our expectations going into the end of the year?
Right. We just wrapped up first quarter earnings season, and that was very strong. So that string of companies beating expectations continues here into the first quarter prints, both on the earnings side and the top line revenue side. So sales growth has been very strong. So one of the main catalysts for the positive returns that we've seen 6 of the past 7 months that you mentioned. So, and as we look at the full year, 2024 and 2025, the graph that we're showing here basically looks at the earnings progression or the path of earnings for each of the 3 years, 2023, 2024, and 2025. And our takeaway here is pretty positive as we look at the progression of 2024 earnings and 2025 earnings, because what we see is that 2024 earnings are showing about 11% growth rate year over year. And as we look out to 2025, we see also a double-digit earnings expectations of about 14%. And so far, these expectations are holding steady. We're not seeing them decline precipitously like we have in previous years. And just looking back at how this impacts what we're thinking about the financial markets. So as you mentioned, valuations are fairly expensive, and that's been the case for a while now. So as we think about where the advances in the stock market could come from,
Right.
it's probably not going to be from multiples expanding further.
Right.
It's not going to be from PE multiples expanding from 20 to 25, for example. And if we do get further advances, it's going to be from corporate earnings growth. So we're encouraged the fact that expectations for this year are holding steady, and expectations even for next year are also holding steady at double-digit growth rates.
And Dan, as we think about our outlook for the markets through the rest of the year, we're obviously impacted by the fact that this is an election year, and a lot of investors are focused on what the outcome of that election might mean for the financial markets. You want to talk a little bit about what we typically see in an election year in terms of volatility through the summer months and what we're expecting to see this year?
Sure. So the typical pattern is we do see some volatility in the summer months. That we all know the financial markets hate uncertainty, and that's no different this time around. We do take a little bit of comfort in the fact that we know who the candidates are and we know their platform. So if we did experience some volatility here in the summer months, we would expect it to be shallow and fairly short-lived. Again, because there's not a lot of uncertainty with who the candidates are and what their policies are. But again, very, very well could experience a 5 to 10% correction in the stock market here this summer. And then just an overall outlook, sticking with politics for a second, we do think that the financial markets will remain supported by a fairly significant amount of fiscal aid coming from the U.S. government. So quite a bit of spending still. Shouldn't be too much of a surprise again in an election year. And overall, outlook remains positive based upon the strong corporate earnings that we talked about. Economy remains resilient, and labor market's fairly healthy.
And with that, we want to thank you for watching. We hope you found value in the video, and obviously feel free to share the video with others if you think they might find value as well. And as always, we sincerely appreciate your continued trust and support.